Welcome to the Merging Life and Money Show, the live show and podcast dedicated to helping professional women achieve financial wellness by merging the emotional and practical sides of money. April is Financial Literacy Month, so we should be focusing on improving our understanding of money matters. During the next 3 weeks, including this week, I will concentrate on improving your financial situation. With so many of us juggling bills, loans, and savings for those rainy days, being financially literate is more important than ever. We must arm ourselves with the knowledge to make better financial decisions and secure a brighter financial future. I will tell you that throughout this month, countless organizations are offering workshops, webinars, and resources that will teach you the ins and outs of budgeting, investing, and debt management. So make sure to check them out, as I do not want you to lose this fantastic chance to sharpen your abilities and emerge as a financial genius. Remember that knowledge is power, and a penny saved is a penny earned. So make April count by boosting your financial IQ. Welcome to the Merging Life and Money Show. Before I get into it, let me introduce myself. If I'm meeting you for the first time, I am your host, Marie-Jo César. Make sure to tune in every Thursday at 7 p.m. Pacific Standard Time for a live broadcast with yours truly. I am here to give you the tools, techniques, inspiration, and motivation you need to achieve financial wellness and live your life with means and meaning. And this month, I will be concentrating on financial literacy related topics. Thank you for joining in today. So grab a beverage of your choice and get comfortable. Again, it is going to be a long and interesting episode. So you might also want to grab a pen and a notebook so that you can take some notes to share and talk about with your family members, your friends, your neighbors, coworkers, and more. By the way, if you are listening on iTunes and Spotify, Google Podcasts, those many other radio platforms, I welcome you. I am so glad you joined in today. So let us get going. As I mentioned a few moments ago, I am going all out to celebrate Financial Literacy Month. And today, I will dig into 3 fundamental aspects of building a robust financial foundation. The art of goal setting, which is crucial, yet often overlooked aspect of personal finance, budgeting and expense management. And I will also explore saving and investing for the future. So when you embrace and master these cornerstones, they will not only help you become financially stable, but they will also give you a sense of freedom and security. So before I get any further, let me give the show some context. Let's imagine that you are an adventurer exploring the ever-changing landscape of money matters in search of financial tips and tricks. If you were, you ended up on the right path. Because today I will be tackling, as I said, the critical topic of building a strong financial foundation. I will uncover the secrets of setting crystal clear financial goals, creating a practical budget, and managing expenses like a pro. So together we will navigate the twists and turns of financial wellness, fueled by our mutual desire to learn, to grow, and to thrive. So let me say that you just embark on a captivating and transformative experience as we wander through the art of laying the groundwork for a bright financial future, one filled with opportunity, security, and abundance. This leads me to the first exploration or point of today's show, the art of goal setting. Just like a compass guiding a ship through rough waters, clear financial goals will guide you through the complexities of life, helping you to navigate life's twists and turns with confidence and conviction. In this section, I will talk about how to set short term, medium term, and long term goals. This will help you make a personalized plan to reach your financial goals. So, let's first talk about the importance of goal setting in the personal finance space. It is of utmost importance to recognize and understand the paramount significance of goal setting when dealing with personal finance. Goals are really the bedrock of your financial pathway, providing structure, providing a sense of purpose, a sense of direction, and providing motivation to make your financial decisions. Because without clearly defined objectives, you might find yourself drifting aimlessly, unable to make meaningful progress toward financial wellness. As a matter of fact, setting financial goals require a deep understanding of your current circumstances, your values, and your aspirations. It is only when you identify what matters most to you, whether it is purchasing a home, saving for your child's education, or achieving financial independence, that you will be better equipped to make informed decisions and stay the course during life's inevitable ebbs and flows, as they say. Also, you must remember that goal setting is a dynamic and ever evolving process. Therefore, you must adapt to change and celebrate each milestone along the way. Here are five specific examples of why having goals is important for personal finance. Prioritization. With so many financial needs and wants to juggle, it is easy to feel overwhelmed. That I know. Therefore, having a clear goals helps you prioritize your objective, allowing you to allocate your resources effectively and avoid spreading yourself too thin. Two, motivation. Setting goals provides motivation and a sense of purpose. So when you have a target to work toward, such as saving for a down payment on a house or eliminating credit card debts, you are more likely to stay focused and disciplined in your financial habits. Three, informed decision making. Goals offer a framework for evaluating financial decisions and helping you make choices that align with your priorities. For instance, if your goal is to retire early, you may choose to invest more in your retirement accounts or cut discretionary spending to reach that objective. Four, tracking progress. By setting financial goals, you establish benchmarks that allow you to track your progress over time. Therefore, review your goals regularly and assess your performance, as doing so will help you identify areas for improvement, celebrate achievements, and adjust your plans as needed. Accountability. Financial goals create a sense of accountability, pushing you to take responsibility for your financial well being. And so set goals and share them with a trusted friend, family member, or a financial professional, because you will have established an external commitment that will help keep you on track. Now, I would like to talk about defining short term, medium term, and long term goals. It is very important to make the difference between these types of goals simply because each of them has its unique characteristics and significance, allowing you to create a holistic, well rounded plan that addresses multiple aspects of your financial life. What are short term goals? They are stepping stones as they give you immediate focus and motivation. These goals are usually met within a year, as they address immediate needs or desires and help build financial discipline. So, achieving short term goals offer a sense of accomplishment, building momentum for your long term objectives. So, here are some specific examples of short term goals: building an emergency fund of 3 to 6 months worth of living expenses, saving for a special event such as a wedding or a family vacation, reducing or eliminating high interest credit card debt, starting a side hustle to supplement your income, or creating and sticking to a monthly budget. Medium term goals, on the other hand, are like milestones along your financial journey. They range from 1 to 5 years and they involve more significant financial commitments and require sustained effort and planning. So, medium term goals often focus on life transitions, personal growth, or acquiring assets. Here are some examples of medium term goals. Saving for a down payment on a home would be a good example. Purchasing a new car, investing in further education, such as a master's degree or professional certification, starting a small business, or pursuing an entrepreneurial venture, or aggressively paying off student loans and other debt. Lastly, long term goals represent the horizon of your financial landscape. With a timeline extended beyond 5 years, these objectives demand patience, persistence, and strategic planning. So, here are some examples of long term goals: achieving financial independence or early retirement, funding your child's college education, paying off your mortgage, building a substantial investment portfolio for long term growth, establishing a charitable foundation, or leaving a legacy for future generations. Next, I will talk about the importance of aligning your goals with personal values and priorities. Your financial goals should reflect your personal values and your priorities. So, when you align your financial objectives with what truly matters to you, you will be more motivated and committed to achieving them. So, this alignment ensures that your financial decisions are driven by your core beliefs, increasing the likelihood of long term success. Here are a few strategies that will ensure that your financial goals embody and support what matters most to you. Self reflection is the first one. Take the time to introspect and identify your core values, your passions, and your long term vision. Consider aspects such as family, career, personal growth, and community involvement. And once you understand what drives you, you can create financial goals that harmonize with your authentic self. Two, prioritization. Life is a dynamic and ever evolving landscape with competing demands and shifting priorities. So make sure to assess your financial objectives in the context of your values and priorities by ranking them according to their importance. This clarity will enable you to allocate resources effectively and maintain focus on what truly matters. Three, balance. Strive for a balanced approach to goal setting and address the various dimensions of your life, namely personal, professional, and financial, and create a diverse range of goals that allows you to cultivate a sense of harmony and well-being and foster sustainable progress toward financial wellness. Four, flexibility. Embrace the ebb and flow of life and adapt your financial goals to accommodate changing circumstances and priorities. Make sure to regularly review and adjust your objectives to ascertain that they remain relevant and still resonate with your evolving life vision. 5, accountability. Share your value aligned goals with a trusted friend, family member, or a financial professional. In so doing, you are creating a support system that encourages you to stay true to your authentic self and make sure to engage in open and honest conversations about your financial journey, as it will allow you to foster a sense of community and shared growth. So, by aligning your financial goals with your personal value and priorities, you are creating a purpose driven roadmap that guides your financial decisions and fosters lasting fulfillment. So, embrace the journey, savor the milestone, and remember that each step brings you closer to a future abundant with meaning, prosperity, and possibility. So, before moving on to the next point, I am going to talk about the SMART goal setting principle. To effectively set financial goals, consider using that SMART method. SMART stands for specific, measurable, achievable, relevant, and time bound. This method ensures that your goals are well defined, realistic, and aligned with your values, making it easier to track your progress and maintain motivation. Now, let's unpack the component of this clever method and find out how it can help you get ahead financially. One, specific. Sharpen the focus of your goals by defining them with precision and clarity. Like a master archer aiming for the bullseye, a specific goal such as saving $10,000 for a down payment on a home offers a clear target to strive toward, maximizing your effort and resource allocation. 2, measurable. Quantify your objectives by establishing tangible benchmarks that enable you to assess progress and performance. Because when you set a measurable goal, such as reducing your debt by 30% within 2 years, you create a yardstick that fosters accountability and drives continuous improvement. 3, achievable. Set your sights on realistic and attainable goals that align with your current financial situation and your capabilities. Realistic goals, such as increasing my saving rate by 10% within 6 months, provide motivation and a sense of possibility, fueling your journey toward financial wellness. 4, relevant. Ensure your goals harmonize with your personal values, your priorities, and your overarching life vision. Relevant goals such as invest in socially responsible funds resonate with your unique aspirations, fostering commitment and persistence. And 5, time bound. Establish a clear time frame for achieving your goals, instills a sense of urgency and focus. Deadline, like the ticking hand of a clock, encourage decisive action and prevent the inertia of procrastination by ensuring steady progress toward your financial objectives. In short, the SMART goal setting method will guide your financial journey and move you toward a bright future. I would definitely suggest that you embrace the process. And I will end this point by saying that goal setting in personal finance is vital because it helps you prioritize, it motivates you to take action, it fosters informed decision making, it enables progress tracking, and it promotes accountability. So, by setting clear financial goals, you are better equipped to navigate your financial journey and achieve long term financial wellness. So, remember that your goals are dynamic and evolving as your circumstances, your priorities, and your aspirations change. So review and adjust your goals to ensure that they remain relevant and achievable, thus helping you to stay on track while on your path to financial wellness. Now to the second point, creating a budget and managing expenses. A well-crafted budget is a cornerstone of a strong financial foundation. Therefore, when you create and maintain a budget, you are gaining control over your finances, ensuring that your money is working for you rather than against you. First, I would like to talk about the importance of a budget in financial planning. A budget is a blueprint of your financial structure, a carefully thought out plan that maps out the allocation of resources, that balances competing demands, and strengthens the foundation of your financial wellness. So, why is a budget an important part of financial planning? And how can it change your financial situation? Here's a list of benefits that I came up with. One, control and visibility. A well crafted budget gives you the gift of control, offering you a clear and comprehensive view of your income, your expenses, and your financial priorities. The visibility empowers you to make informed decisions and empowers you to optimize resource allocation and allows you to steer your financial ship with intention and precision. Two, goal alignment. By incorporating your financial goals into your budget, you establish a tangible and actionable roadmap that guides your daily financial choices. This alignment ensures your hard earned resources are channeled toward your most cherished dreams and aspirations. Three, debt management. A robust budget provides you with the necessary tools you need to tackle debt in a strategic fashion, allocating funds toward high interest debt and creating a sustainable plan for reducing your financial liability. Four, savings and investment. Budgeting facilitates the growth of your savings and investments by carving out dedicated resources for these purposes. This deliberate approach cultivates financial security while fostering a sense of confidence and well being. Five, financial agility. By closely monitoring your budget, you develop a keen awareness of your financial landscape. That enables you to adapt and respond to life's unexpected challenges and opportunities with grace and resilience. And as you venture forth on this exciting journey, embrace the power of budgeting and remember that a well designed budget serves as both a compass and a guardian, guiding you toward your most fulfilling financial life. Now, let's explore the different budgeting method, as there is one that meets everyone's needs. I will also provide example to help you identify the approach that resonates best with your unique financial circumstances, as they have each their pros and cons. One, zero-based budgeting. Basically, you are starting with a clean slate each month, allocating every dollar of your income to specific expenses, savings, and debt repayment until your budget balances to zero. With this method, you ensure every hard earned dollar and cents have a purpose, fostering intentionality and control over your financial resources. For example, if your monthly income is $4,000, you will allocate funds to categories such as housing, utilities, groceries, transportation, savings, and debt repayment until every dollar is assigned, leaving a balance of zero. Two, the 50-30-20 budgeting. Embrace the simplicity of this rule of thumbs approach, which divides your after tax income into three categories: 50% for essentials, 30% for discretionary spending, and 20% for savings and debt repayment. For example, if your after tax income is $9,000, you will allocate $4,500 for essential, rent, groceries, utility, that kind of stuff. 2,700 for discretionary spending, like dining out, hobbies, entertainment, and $1,800 for saving and debt repayment. Three, envelope system. Channel the spirit of the past era with this tangible cash based budgeting method. Allocate cash to envelopes labeled with specific spending categories. And once the envelope is empty, you have reached your spending limit for that category. For example, if you allocate $900 for groceries each month, place that amount in a labeled envelope, and as you shop, use cash from the envelope. And once it's empty, you have hit your spending limit for the month, doesn't matter which day of the month it is. Four, value-based budgeting. Craft your budget in harmony with your personal values and priorities, ensuring that your financial resources support what matters most to you. For example, if you prioritize travel and personal growth, allocate a more significant portion of your budget to these categories while reducing spending in less meaningful areas, such as dining out or entertainment. So take a look at these examples and decide on the approach that best aligns with your personal landscape, your goals, and your preferences. Remember that the most effective budget is one that resonates with your unique circumstances, one that aligns with your financial goals, your preferences, and lifestyles, and empowers you to navigate your financial journey with intention, confidence, and grace. Now, let's explore the importance of monitoring your expenses and scrutinizing your spending habits. In doing so, you will find out how you can elevate your financial insights and take charge of your fiscal destiny. Here are a few guidelines. Awareness and understanding. Regularly tracking your expenses fosters a heightened awareness of your financial landscape. It helps you find out where your money goes and reveals potential areas for optimization. Because when you understand your spending pattern, you can make more informed decisions that align with your financial choices, with your goals, and with your priorities. Two, accountability. Monitor your expenses, creates a sense of personal responsibility as it encourages you to adhere to your budget and maintain control over your financial resources. This accountability can help you stay on track to meet your financial objectives, fostering progress and growth. Three, identify trends and areas for improvement. By analyzing your spending habits, you can uncover trends and potential areas for improvement, such as reducing discretionary spending or reallocating resources to savings and investment. This process enables you to refine your budget, ensuring that it remains dynamic and can be adjusted to your evolving needs and goals. Four, tools and techniques. Choose tracking methods that resonate with you and your unique circumstances. Options include traditional pen and paper approaches, spreadsheets, or financial tracking apps that offer convenience, automation, and personalized insights. Regular review. Number five, schedule consistent reviews of your tracked expenses, such as weekly, bi-weekly, or monthly, awareness of your spending habits, and facilitate adjustment as needed. So once you embrace the practice of tracking your expenses and analyzing your spending habits, you will gain valuable insight and develop a deep and detailed understanding of your financial landscape. This knowledge will empower you to make intentional and strategic choices that will strengthen your financial foundation and propel you toward a future rich with opportunity, security, and prosperity. So remember The journey toward financial wellness is one of self discovery, growth, and continuous learning. So enjoy the process, savor it, celebrate your progress, and let your newfound insights guide you toward your most fulfilling financial life. I will mention two important points before giving you a few tips for adjusting your budget based on your findings and your financial goals. One, categorize and prioritizing expenses. You might think that creating a budget can seem daunting, but think again and look at it as a tool to help you reach your financial goals. Make sure to categorize your expenses into fixed and variable. Your fixed expenses, such as rent or mortgage payments and utilities, stay constant each month. Meanwhile, variable expenses like groceries, entertainment, or clothing can fluctuate based on your needs and or wants. So once you have identified your expenses, the real work begins. That is prioritizing your spending. Allocate your resources to what is most important, such as paying off debt or saving for a down payment or on a house. And in doing so, you can achieve your financial goals faster. So take control of your finances and make a budget that works for you. Because again, every penny counts. Two, establishing and maintaining an emergency fund. We all know that life can throw us curveballs when we least expect it. It could be a sudden car repair you didn't see coming, or it could be a job loss that catches you off guard. So, whatever the case may be, having an emergency fund can provide a sense of security when unexpected expenses arise. But it is not just about having that fund, it is about regularly contributing to it and resisting the urge to use it for non emergency expenses. Think of it as a safety net for your finances, providing peace of mind when life surprises you. So let's make sure to prioritize your financial well being by building and maintaining a strong emergency fund. I will end this second point by exploring some practical tips for refining your budget, ensuring it remains a living, breathing reflection of your evolving circumstances, your priorities, and your aspiration. One, reflect on your findings. Okay, take time to review and analyze your tracked expenses, seeking patterns, trends, and areas for improvement. Also, reflect on how your spending habits align with your financial goals, identifying potential shifts in resource allocation that could optimize your progress. Two, revisit your goals and priorities. As you adjust your budget, remember to maintain a clear focus on your financial objectives and your personal values, and ensure your budget adjustments support your goals and resonate with your unique priorities, fostering a sense of harmony and intentionality in your financial choices. Three, adjust spending categories. Based on your findings, consider adjusting spending limits in specific categories to better align with your financial goals. This may involve reducing discretionary spending, as I mentioned before. This may involve increasing savings or investment allocations, or reallocating funds to tackle debt more aggressively. Four, embrace flexibility. Recognize that your financial landscape and goals may shift over time, and be open to revisiting your budget periodically to make adjustment as needed. So embrace flexibility as an essential aspect of your financial journey, cultivating a resilient and adaptive mindset. Five, seek support. If you're unsure of how to adjust your budget or would like professional guidance, consider seeking the advice of a financial professional, a coach, or a mentor, because Engaging with others who share your financial values and aspiration can provide valuable insight and support. 6, monitor progress and iterate. Okay, so as you make your budget adjustment, continue to track your expenses and monitor your progress toward your financial goals. Use your findings to refine your budget further, iterating and adapting your approach as needed to maintain momentum and foster growth. Once you embrace these tips for adjusting your budget based on your finding and financial goals, you will cultivate a proactive and adaptive approach to managing your financial resources. This mindset will enable you to navigate life's complexities with grace and resilience, charting a course toward a future abundant with possibility, security, and financial wellness. Remember, the journey toward financial empowerment is one of continuous learning, self discovery, and growth. So, again, enjoy the process, celebrate your achievements, and let your ever evolving budget be your compass on this exciting journey. Now, to the third and final point of today's show: saving and investing for the future. Building a strong financial foundation requires a long term perspective, including saving and investing for the future. In this section, I will explore the power of saving and investing and uncover strategies that will shape your financial future, one wise decision at a time. So before I proceed, I must mention some important disclaimers. The content featured on the Merging Life and Money show is solely meant for informational and educational goals and does not constitute legal, tax, accounting, or investment counsel. It is by no means a substitute for professional advice in this domain, and I highly recommend that you seek the help of your own tax, legal, investment, and accounting advisors before taking any action or committing to any transactions. I will first explore the significance of retirement savings, highlighting the critical role it plays in ensuring your long-term financial security, independence, and peace of mind. So saving for retirement is a critical component of a strong financial foundation. It is critical that you start early and contribute consistently to your retirement savings. Here are some essential and foundational concepts that you must become familiar with. Time and compound interest. The magic of compound interest is fundamental for retirement saving, enabling your capital to rise exponentially. So start saving early, and so your nest egg will blossom. 2, rising life expectancy. With the increase in women's life expectancy due to technological and healthcare developments, we are living significantly longer. By making retirement saving a priority, you will be ready to tackle the challenges and take advantage of the opportunities of an extended retirement and still maintain your autonomy and financial freedom. 3, uncertain future of Social Security. As we deal with evolving economic and demographic dynamics, the future of Social Security benefits is questionable. Therefore, you must focus on retirement savings as it will empower you to manage your financial future while curtailing your dependency on external revenue stream. Just take a look at what is happening in France right now. 4, financial freedom and flexibility. A well-established retirement savings plan grants you the liberty and flexibility to enjoy your golden years on your own terms. It allows you to pursue hobbies, travel, and other goals without having to worry about financial burdens. So, by highlighting the importance of saving for retirement, You will be well equipped to navigate the ever evolving landscape of personal finance by laying the groundwork for a successful and fulfilling future. Remember that your retirement savings strategy is a testament to your foresight, your wisdom, your dedication, and a tribute to your enduring commitment to financial wellness and long term security. Now, let's pause for a moment to examine the diverse array of investment vehicles that are at your disposal. I will break down various investment vehicles and discuss their pros and cons so that you may be empowered to make informed and strategic decisions that align with your financial goals and your risk tolerance. One is stocks. When you buy stocks or shares, another word for stocks, of a company, you become a shareholder, acquiring partial ownership and the possibility to benefit from the company's success. This investment opportunity offers the potential for high returns, long-term growth, as well as dividends. However, it is essential to be aware of the associated risks, including market volatility and the potential for significant losses, as investing in shares generally carries a higher level of risks compared to other investment vehicles. 2. Bonds. When you buy bonds, you are essentially lending money to an entity, such as a government or a corporation, that promises to pay interest and return the principal at the end of the bond's term. This type of investment typically present a lower risk compared to that of stock, providing a predictable income stream and added stability to your portfolio. However, bonds may offer lower returns and are susceptible to inflation and interest rate risks, which can impact their overall performance and value. Mutual funds. Such investment vehicle gather funds from numerous investors to acquire a diverse array of assets, including stocks, bonds, and other securities. This investment option offers the advantages of diversification, professional management, and ease of buying and selling. However, investors should be aware of the potential drawbacks, such as management fees, the possibility of underperformance compared to the broader market, and reduced control over individual investment choices within the fund. 4. Exchange traded fund, known as ETFs. They resemble mutual fund in that they hold a diverse array of assets, yet they differ by being traded on stock exchanges like individual stocks. ETFs offer diversification, lower fees compared to mutual funds, tax efficiency, and liquidity, and they present several advantages to investors. However, they have some potential drawbacks, just like the others, that include trading costs, potential tracking errors in replicating the performance of the underlying index, and limited control over the specific holdings within the ETF. 5. Real estate. Real estate investments involve acquiring property which can generate rental income and appreciate in value over time. This investment option presents several advantages, such as tangible assets, the potential for passive income, diversification within your portfolio, and some tax benefits. However, real estate investment come with potential downsides, including illiquidity, high upfront costs, ongoing expenses for property maintenance, and susceptibility to market fluctuations that may impact property value. So once you understand the pros and cons of these investment vehicles, you can have a comprehensive insight into your option and make informed decision, keeping in mind your financial goals, your appetite for risk, and your individual preferences. Also, keep in mind that a well-constructed investment portfolio is a dynamic and ever-evolving representation of your financial objectives, reflecting your understanding, your foresight, and your commitment to achieving a successful future. Now, I'm going to share some tips for diversifying your investment portfolio. So, to mitigate risk and maximize returns, it is essential to diversify your investment portfolio. Diversification involves spreading your investment across different asset classes, industries, and geographic regions, reducing the impact of any single investment on your overall portfolio and fostering stability during the ever-changing tides of the financial markets. Here are the few tips. 1, having a variety of assets. It is essential to diversify across different asset classes such as stocks, bonds, real estate, and cash. So by spreading your investment across multiple categories, you can mitigate the impact of market fluctuation and reduce your overall risk. 2, sector diversification. When it comes to asset classes, it is best to diversify your investments across various sectors such as technology, healthcare, finance, and consumer goods, as examples. This approach further insulates your portfolio from industry-specific risks, promoting stability and resilience. 3, global reach. Broaden your horizon by investing in both domestic and international markets. This global perspective allows you to capitalize on opportunities beyond your borders and fosters balance in the face of regional economic shifts. 4, size matters. Diversify your portfolio and take into consideration large and small cap enterprises and also startups. Each market segment offers unique growth potential and risk profile, adding depth and balance to your portfolio. 5, timing your investment. Let me say that again. Timing your investment, not timing the market. Not timing the market. Utilize strategies like dollar cost averaging, where you invest a fixed amount at regular intervals, regardless of market conditions. This approach smooths out the impact of market volatility and can lead to better long-term results. 6, rebalancing and reassessing. Periodically review and rebalance your portfolio to maintain your desired level of diversification. As your financial goals and risk tolerance evolve, make adjustments to ensure that your investments continue to align with your objectives. Embrace these tips for diversifying your investment portfolio, and you will be in a great position to skillfully manage the fluctuation of the markets. In doing so, you can create a strong financial base that will stand up to the test of time. So remember that a properly diversified portfolio is like a harmonic blend of financial instruments, each contributing to attaining success, security, and financial wellness. Now, let's dig into assessing risk tolerance and discussing investment strategies. 2 other important tactics that you must be fully aware of and comfortable with because they will empower you to make informed decisions that resonate with your values, your goals, and your aspiration. Here are 6 keys. 1, know thyself. Begin by conducting a thorough self-assessment, reflecting on your financial goals, your time horizon, and your personal comfort level with risks. You must also consider your current life stage, your future income expectations, and your overall financial situation to gauge your capacity for risks. 2, seek balance. Aim to achieve a balance between risk and reward by selecting investments that align with your risk tolerance while offering the potential for growth. Remember that a balanced portfolio combines a variety of asset classes, sectors, and investment types to create a harmonious risk reward profile. Three, conservative strategies. For those of you with a lower risk tolerance, prioritize stable investments such as bonds, money market funds, and dividend paying stocks. These investments typically offer more predictable returns and lower volatility, providing you with a sense of security and stability. Four, moderate strategies. For investors with moderate risk tolerance, adopt a blend of conservative and aggressive investment. This approach balances the stability of low risk assets with the growth potential of higher risk investment, thus creating a well rounded portfolio. Five, aggressive strategies. If you have a higher risk tolerance, consider incorporating growth oriented investments such as stocks, real estate, and emerging market funds into your portfolio. So while these assets may be volatile, they offer the potential for high returns and long term growth. Six, consult an expert. If you are unsure about your risk tolerance or need guidance in developing a tailored investment strategy, consider seeking the advice of a financial professional. Their expertise can help you navigate the complexities of investing and ensure that your approach aligns with your unique financial goals and risk profile. The fact is that by evaluating your risk tolerance and customizing your investment strategies according to it, you can put yourself in a great position for financial success. And you will be able to navigate the dynamic markets with grace, wisdom, and foresight. Remember that your investment strategy should reflect your personal values, your goals, and your aspiration. This will be a definite testament to your unwavering commitment to building a secure financial future. One more point before wrapping up this episode: strategies for balancing various financial goals, such as building an emergency fund, repaying debt, and investing for the future. The reality is that when you prioritize your goals and allocate your resources accordingly, you can make steady progress toward financial wellness. So let me share 6 such strategies with you. 1, establish a solid base. Begin by creating a robust emergency fund to cover at least 3 to 6 months worth of living expenses at least. This financial safety net will provide a critical buffer against unexpected hardships, ensuring that you can weather life storms without jeopardizing your long-term financial goals. 2, tackle high interest debt. Focus on repaying high interest debt such as credit cards or personal loans, as it quickly can erode your financial health. So by prioritizing debt reduction, you will free up resources to allocate toward other financial goals like investing and saving for the future. 3, embrace automation. Set up automatic transfers to allocate a portion of your income towards your financial goals, such as emergency savings, debt repayment, and investments. So this pay yourself first approach ensures that you are consistently working towards your objectives, making it easier to stay on track. 4, strike a balance. Divide your disposable income between various financial goals such as emergency savings, debt repayment, and investing based on your unique circumstances and priorities. Okay, that is your life, not your neighbor's. Consider using a percentage-based allocation system to maintain a balanced approach, adjusting it as needed to accommodate your changing goals or circumstances. 5, revisit and reassess. Periodically review your financial goals and progress and make adjustments as needed to align them with your evolving priorities and financial situation. I will add that these regular check ins help you stay on track and ensure that your financial plan remains relevant and effective. 6, seek expert guidance. If you need assistance in balancing your financial goals, consider consulting a financial professional. Their expertise can help you develop a tailored plan that addresses your unique needs while ensuring that your approach remains aligned with your values and objectives. So, by adopting these strategies for balancing various financial goals, you can create a comprehensive and flexible strategy for managing your personal finances. So, you will be able to skillfully navigate the complex interaction between your different priorities and build a solid and stable financial base. I will end this point by stating that your financial venture is a delicate balancing act of priorities and goals, with each move precisely planned to form a balanced and prosperous financial future. I'm going to wrap it up now. I know it was long, but it was an important episode. So let's recap. I talked about 3 main components for building a strong financial foundation, and I focused on setting clear financial goals. I talked about creating a budget and managing expenses. And I also talked about saving and investing for the future. So by focusing on this component, I explained that you can create a comprehensive financial plan that will guide you toward financial wellness and success. So as we wrap up today's show, let's take a moment to reflect on the valuable insight and strategies discussed throughout this episode today. Remember that financial wellness is a lifelong journey, and the key to success lies in continuous learning and adapting to new challenges. So stay proactive in your pursuit of financial literacy and never hesitate to seek guidance from experts or further your education on the subject. So by staying informed and committed to your financial goals, you can create a secure and prosperous future for yourself and your loved ones. This is all I have for you today. So go forth, take control of your finances, and create a strong financial foundation that will serve you well throughout your life. As you know, I like to go with inspiring words just taken for this show, and here they are. Budgeting is the art of aligning our financial decision with our values and priorities, ensuring that our money works for us. This brings us to the end of today's Merging Life and Money episode. A big thanks to all of you, my wonderful listeners and followers, for being part of this financial literacy journey today. It has been a pleasure to share my thoughts with you, and I hope that you found this episode informative and inspiring. So make sure to watch the replay because it was packed and share it with others. So let us join forces and champion financial wellness for women, one savvy decision at a time. So keep learning, keep growing, and together we will build a world where financial independence is within every woman's reach. Stay tuned for more live show and podcasts covering a wide range of financial wellness topics. I will see you next week, Thursday, at 7 p.m. Pacific Time, 8 p.m. Mountain Time, 9 p.m. Central Time, 10 p.m. Eastern Time, 11 p.m. Atlantic Time, and noon Friday, Brisbane, Australia time for my Australian friends. Thank you for being here today on the Merging Life and Money show. So to stay connected, be sure to follow me on social media and subscribe to my podcast. Let's continue our journey to financial wellness and success. I am your host, Marie-Jo César. I will be back again next week. Until then, continue merging life and money. Bye for now.